Everyone, thanks so much for the opportunity to be here. This is pretty awesome. I'm with this paper's with Robert Hills and Matt Kubik, who are two co-authors of mine, but we're Duke PhD students. Matt's starting at UT in the fall, and Robert's a year ahead of him. They were office mates at Duke in the PhD program, and so they're kind of have some expertise in this area. Matt works with a lot of SEC interaction type ideas, and Robert does a lot of financial accounting and tax work, so has some knowledge of how kind of the global economy works a bit. And so I guess the way I'm involved in this paper is I just got to be collegially involved with some of the discussions they were having as office mates. So I'm happy to share with you this paper that we're working on. You can see, for example, the research question here is pertaining to SEC effort regarding disclosures on terrorism. Does that have any impact or limit financial reporting oversight? And to give you some idea about that, let me clarify some of the terms here in this research question. So when we're talking about SEC effort to regulate, what we mean is at the SEC, there's a division of corporation finance. And what they're going to do is oversee disclosures that firms make, so filings, and they're going to allocate resources for that. So you can see there, this is just a blurb from their website. They concentrate resources on critical disclosures that appear to conflict with, for example, accounting standards, and on disclosures that are materially deficient. So that's in some sense, the trade-off we're talking about here. In terms of what is SST, what is a state sponsor of terrorism? Well, the Department of State in the US will designate, they have designated certain countries as state sponsors of terrorism. And that list changes. It's been pretty stable since 1996. This is the list that of countries that fall into that category for our paper. So that's what we mean by SST in terms of the term state sponsors of terrorism. So that's something designated by the Department of State in the US. When we're talking about disclosures about SST, let me give you a couple examples. So in comment letters that the SEC would send to companies, here's one from Mattel, and they say, we note that we saw a news article saying that there were Barbie dolls being sold in Iran. And Mattel will respond back to the SEC and said, hey, we haven't sold anything to anybody or any entity in Iran. We haven't done business there. So that's the nature of this sort of question. Here's another example for you about the types of oversight on terrorism you see from the SEC. They said to the firm DocuSign, your website has a list of time zones, and some of the time zones listed on your website include Iran and Syria. And DocuSign came back and said, well, yeah, we have 96 time zones internationally, and we have all of them in there. We're just being comprehensive. We don't have any terrorist involvement, or we're not dealing with a state sponsor of terror. So that's what we mean by disclosure effort in terms of oversight on SST. And so you might ask yourself, okay, fine. Why do we care about this? Why is it important to consider the SEC's monitoring or efforts pertaining to SST disclosure? And here's a comment letter trend. So the big four accounting firms tabulate this stuff to try to tell their clients, hey, this is where the SEC is focusing their attention. And in one of the recent tabulations, you can see the state sponsors of terrorism. That's becoming a top 10 issue. It showed up in 12% of the comment letters that firms have received. And that's in the same ballpark of other things we care about. Revenue recognition is 13%, income taxes is 12%. That's of the firms that get comment letters, that's what the SEC is commenting on. And so, state sponsors of terrorism are becoming important. So that's one reason we care about it. The other reason is there's some tension as to whether this is in some sense a good or bad thing. So some argue that the SEC should not be doing this. So some argue, for example, this is not the SEC's mission to be concerned about foreign policy matters. They don't have the expertise to do it. They don't have experience. So why don't you leave that for the parts of the government who are good at doing that? In terms of others suggesting there might be political pressure to actually do this, so beyond the expertise issue, Mary Jo White even said, hey, look, sometimes Congress or special interest groups try to try to push us in terms of doing things that may not fit exactly with our core mission. You see down there at the bottom, the Organization for International Investment. That's a trade organization for foreign subsidiaries. They basically said, look, SEC, why are you spending so much time on terrorism? You could be spending your time on all sorts of things like environmental policies and labor and charitable contributions. Why are you unduly, in some sense, focused on this? So the spirit of these sorts of comments is the SEC shouldn't be doing this. It's inefficient if they do it. It may not lead to good outcomes if they do it. The flip side of that is the SEC, at the behest of Congress, formed what's called the Office of Global Security Risk. Now, this works right within the Division of Corporation Finance, who reviews filings, and their role is simply to support the Division of Corporation Finance on global security related issues. So it's a special subgroup that's just a support group that's designed to help with things like terrorism disclosures. So when we're talking about terrorism, we're really talking about global securities risk in the eyes of the SEC. And what they're trying to do here is essentially make sure that investors have material information about global security risk issues, one of which would be involvement with state sponsors of terrorism. So that's the tension. So we don't know if there's enough support within the budget to actually go after SST, or if there's some sort of budget constraint. You can imagine if the Division of Corporation Finance has a budget constraint, if they're spending time doing issues pertaining to things they're not good at or things they shouldn't be doing, it might come at the cost or the expense of other oversight issues they should be dealing with. So if you want to kind of put this in a general framework, here's what we see. So conceptually, we're going to try to look at this link between SEC effort to regulate SST disclosures and whether it has any, in some sense, negative effect on the SEC's oversight of financial reporting, which is what we care about, I guess, as accountants to some degree. We're going to measure SEC effort by whether simply there was a comment letter reference to an SST issue. So, for example, if the Mattel example you saw, the DocuSign example you saw, both of those would be a 1, for example, among the set of comment letters. And that's going to be our sample. We're going to look among this set of comment letters. Do you have a reference to SST or not? Our outcome variable is going to be whether the SEC caught a financial reporting error. So you saw at the beginning, the SEC cares about appropriate application of accounting standards. And so what we're going to do here for our outcome measure to measure financial reporting quality is we're going to look at the topics that were mentioned in the comment letter conversation with the company, and then look at whether they had a restatement or not. And if they did the restatement have the same topic that the SEC identified in the comment letter? And if it did, then we're going to code it as a 1, meaning the error was caught, and all other observations are going to get a 0. So we're looking at error detection here as our outcome variable of interest to start with. And so that's the regression specification we're going to run, just a linear probability model, put a bunch of controls in for firm characteristics and audit characteristics, all that stuff. We're not dealing with an exogenous shock. This isn't a difference in difference paper. There isn't a shock to use. I'll show you what we'll have to do then empirically to try to convince you that we have some robust evidence here, but that's the direction we're going to go to start with, is just run a linear probability model and see whether this designation of a comment as state sponsored a terrorism issue in a comment letter is associated with the SEC actually catching an error, catching a financial restatement. So let's look at what we got here. So what we're going to do is I'm just going to progressively kind of show you our regression specification. We'll just start with kind of the univariate case, but I'll also add in branch year fixed effects. So at the SEC, when they review firms, they're bucketized by industry. And so firms always go to the same office based on their industry. And so you might imagine that, budgetary issues at different offices of the Division of Corporation Finance might matter. And so we're just going to control for branch year fixed effects in our base model, and then start looking at what happens with SST. So you see in the base model there, we got a negative relationship. What that suggests is if the Division of Corporation Finance mentions SST, it means it's less likely to catch an error in terms of catching a restatement. If we add control variables, what you're going to see is the coefficient still negative and significant. It attenuates a bit, it drops down. We'll come back and talk about that issue in a second, but we're going to add we're adding a whole host of control variables there. So what you're probably thinking at this point is, yeah, your dependent variable is a 1, 0. The zeros there could be settings where there's no misstatement ever, or there's a restatement that's needed but not caught, right? So, those are sitting in the zeros in terms of our 1-0 variable. So we got to be careful about how we treat those. So one thing we do is we remove foreign filers, because you might say, hey, if you're in a foreign jurisdiction, you're just more likely to be closer to a country that's SST outside the US. And if those firms are more complex in some way, then you're just going to be harder to catch an error. So we kick out foreign filers, which turn out to very rarely have restatements. We basically see the same result. You might push further and say, hey, you know what? But you're still dealing with firms that maybe they didn't have an error at all. Why would you ever consider that sample of firms that have no error condition into the sample that has errors, that we know it, and then ask yourself, did the SEC catch it or not? So that's what you see in column 4. So if we subset into the setting where we know there was a problem, we see the same relationship. Obviously, the point estimate's a little bigger because we're conditioning into a sample with a higher unconditional mean of error detection. Then you might say, oh, hey, you know what? That's fine. I think you have a negative association, but it's all for irrelevant issues. It's for errors, not irregularities, if you will. So if we condition into the severe subset issue, we still see the same effect. All right. So you can do a lot of different things here. You can throw in firm fixed effects instead of branch year. These results are really robust. So then you got to ask yourself, well, what's the alternative explanation? All right. And so here's an example for you. You might say you are missing out on firms that in a given year enter into a globally complex transaction. All right. So that would mean you're more likely to be SST, and you're less likely to catch an error because it's just really hard to figure out how complex transactions map into the accounting system. Let's use that as the unobservable. So the only way to deal with that is to use empirical techniques. So the first one we're going to use is the Oster technique, which is to look at your base model and a fully specified model. And you can see that the coefficient we looked at before on SST attenuates down. So what you do is you compare that to how much the R squared ran up, and you can extrapolate out in some sense, make a bias adjustment on the coefficient of SST. So if you do a bias adjusted coefficient, it's 0.001 negative, whereas in the main specification, it's negative 0.014. So you get, it's slightly lower when you consider unobservables, but what this tells you here is that the effect of unobservables here would have to be 3.8 times more than observables in order for our results to be statistically insignificant, meaning bias is completely driving our results from some unobservable. And you can do that across the board. If you do that test across the board, you're still going to get results that suggest we have when you do the bias adjustment, that we've got results that are negative and robust. You might say, okay, well, there's other ways to deal with that. What about the fact that SST firms are not randomly assigned? So we'll just do your favorite matching technique. We can do all sorts of those. It doesn't matter which one you use. In the first column there, we've got the regression specification from the OLS. That's just being repeated. You can use coarsened exact matching, propensity score, entropy balancing, whatever you want. It's the same result. So that's one way to see if our results are robust. The best thing we can do with some exogenous variation is to try to instrument. Here's what we do there. If on the left-hand side there, if you plot the comment letters over time, you see that they're rising. That's the blue dotted line there. The red line is the number of terrorist events. So there's a database that counts daily terrorist events around the world. You can see they track really highly. So the SEC might be going after issues that match what's going on in the global economy. If you use that as your instrument in the second stage, you're still going to get a negative and significant coefficient. So using instrumental variables techniques, we're still getting a negative coefficient. So what do you make of all that? So I think it's pretty robust. We've got this negative association. And what we think is the reason you get this from our arguments up at the beginning was you're hitting a budget constraint as the SEC. If that's true, there's particular tests we could run to see. So we could look at what other comments happen in the comment letters. Are you asking things that are related to the accounting numbers? So for example, if we take core financial reporting questions, which we designate as accounting questions, questions about non-GAAP, questions about MD&A, those are all going to be related to reported accounting numbers. You can see an inverse relationship here, right? This is just over time. You can see that as there's more SST, there's less questions about financial reporting. If you throw that in a multiple regression specification to remove the time effect, you're going to see here again, you got a very negative coefficient here. So this is a tough piece of evidence to kind of square with alternative explanations, right? So if you think we're just capturing with SST some complexity thing, it would have to be that when things are complex, you also ask less questions about MD&A or non-GAAP or accounting, which, you know, that's a difficult story to tell in our view, but it is consistent with a crowding out, if you will. So if you spend time on SST, the budget constraint is going to crowd you out to monitor financial accounting. So that's what we find there. So then you might say, well, okay, fine. It's not about terrorism. It's just about risk factor disclosures. And it turns out that SST is just one type of risk factor disclosure. So here's what we do. We'll just take all non-SST risk factor comments and put them in place of SST and see what happens. If this is just a risk factor effect in general, then you'd see all the same results as we saw with SST. But you can see that's not the case. Non-SST risk factors are not associated at all with error detection. And if anything, they're positively associated with comments, core financial reporting topics. So the conclusion there is I don't think we're picking up a general risk factor phenomenon. This is terrorism specific. So to round this out, here's what we pursued. We said, all right, if this is really about a budget constraint, we sent a FOIA request to the SEC and said, hey, give us the listing of everybody that works in the Division of Corporation Finance. And then we're going to take those people listed by year, and we're going to map them into the payroll data to see what their occupation is. And here's what we see over time. We see that the number of accountants actually is dropping over time from 51 down to 44, but the number of lawyers is increasing from 36 down to 43, okay? So you're getting a mixed shift in terms of the labor that the DCF has available latently. And so if you look at what happens on the actual comment letters, you see the same trend. So the base latent amount of labor, that sort of trend is showing up on the comment letters as well. So one thing you might say is, well, hey, look, if you're shifting away from accountants, then, you know, if you take Matt Kubik, Matt's got a paper that kind of shows that accountants are better than lawyers at detecting financial misreporting. If you take that at face value, you might say, well, maybe the reason for our findings is coming from the labor mix. So here's what we'll do to check that out. So we'll take our main model and we will just replace team size with the number of accountants and lawyers separately. And then we'll see whether they have a main effect with error caught and whether that operates through SST disclosures. All right, and so here's what we see. If you look at error detection as the outcome in a path analysis, you're going to see a main effect for lawyers that's positive, a negative effect marginally for lawyers. So that means more lawyers, less error catching, more accountants, more error catching from a financial reporting standpoint. And obviously, here's the main effect of the paper so far, which is if there's SST, then you're less likely to catch an error. But is it possible that the accountant and lawyer effects are operating through SST? So how would that look? You'd have to look at the indirect effects. So if we did that, the indirect effects are the multiplication of these two effects. So you can see here, you're multiplying two negative numbers together. That means accountants, through the use of SST, are actually improving error detection incremental to their already positive effect that they have directly. But lawyers are opposite, they're different, okay? There's a negative effect there. So the multiplication of those two effects is negative, meaning that when SST shows up, lawyers are actually reducing error catching. Now you can do the same thing for crowding out. So what's the main effect? We don't really know. What types of questions do accountants and lawyers ask? It turns out that accountants are going to ask more questions about accounting, not surprising perhaps. Lawyers are going to ask less. When you get down to non-GAAP, same pattern here, positive for accountants, negative for lawyers. When you get to the MD&A, more lawyers and more accountants mean more MD&A comments. So accountants and lawyers both, in some sense, are asking questions about the MD&A or making comments about it. But when we turn to the indirect effects, which operate through SST, here's what we see, all right? That's going to be, again, requiring you for accountants to multiply these two together. So we're going to get a positive effect for accountants. Same for lawyers, we did that calculation, negative. So lawyers are crowding out accounting comments when they're talking about SST. They're crowding out non-GAAP comments, and they're crowding out MD&A when they're talking about SST. So as a collection, the evidence suggests to us that SST disclosure regulation, or putting efforts towards that, is leading to a drop in error detection. It's happening, it looks like, at the expense of asking questions about financial accounting, core financial accounting issues. It's not a general risk factor as far as we can tell. And it's at least partially driven by the labor mix at the DCF. Obviously, this is a collection of results. The limitations are we can't observe. Oh, I just lost it. Can you hear me?
We can hear you, but your image is frozen. So.
Oh yeah, I froze out. I don't know why. Well, I'm at the end, so we can switch over. Let me stop sharing, and we can jump to some. Oh, here we go. I'm back. All right. Can you see? Is it frozen out now or good?
Yeah, it's good.
Yeah, it's good.
It's good? Okay. All right. I guess I have maybe like one more minute. I'll just finish out. The limitations are, obviously we can't observe SEC effort directly, obviously. So that's a problem. We're not considering any other.
Bill, we can't hear you.
By looking at SST. And so we make some contributions, we think, to the literature, but with that, let me flip it back. And should I stop sharing at this point or leave it on?
You can leave it on.
Leave it on? Okay, perfect. All right, let's take some questions. Thank you very much.
All right, so I think the first question we had was from Gennaro. If you want to unmute. And...
Hello, everybody.
How you doing?
Pretty good. How are you? Thank
you.
Good,
thanks.
That was very interesting. Thank you. My question was basically, just a little background. I don't know if you spoke about it in the beginning and I missed it, but I don't think so. When you show the graph when the trend started, obviously after 9/11 or beginning of 2000. But was there any specific direction that they should be doing this? I mean, do you have any idea of how this started? Why did they start picking up on this?
Yeah, I mean, part of it was just regular.
And I guess understanding this, the answer to this background question, also trying to help trying to understand your conclusions, where this leads.
Yeah. Well, I mean, so there's been over time for many issues, things get to be hot topics, and since the mid 90s, there were the Iran Sanctions Act. There were various things that happened in the global economy related to terrorism, and what happened was sorry, my Zoom meeting is actually bombing out. Can you still hear me?
Yes.
Okay. I can't see anything, so I'm just going to see if I can get this fixed. But if I drop off, I will try to relaunch it and get back on, but I'm kind of blocked out right now. But in the mid 90s is when it started kind of picking up. And actually, that's when the SEC created the Office of Global Security Risk to help the SEC actually monitor this, as it was just becoming more of a global trend. But there wasn't any like one big shock that made it all happen. I think it was a bubbling of pressure over time and various sanctions. So it turns out our sample starts mid 90s. That's when you can actually get measurements of comment letters. So we can't really do much in terms of empirical measurement before then. So it's not to say that in the mid 90s, suddenly everyone started talking about, terrorism, and they hadn't before. It's been an issue for quite some time. It just, we can empirically start measuring in the mid 90s. Does that make sense?
Oh, it does. So there was no direct. I mean, I guess what I'm wondering is why did they even start worrying about this? What is the principle based on which the SEC would pick up on this?
Well, political pressure. So Congress made them actually start the Office of Global Security Risk. So they didn't even have
So,
that.
I guess that's where my question was. Was there an act of Congress that started this? Is there an official act of Congress that started this?
No. Well, there's official acts of Congress that sanction, various countries. So when you become, for example, part of when you join the list of state sponsors of terrorism, there's issues related to that beyond SEC, obviously. And, what you have there is,
I guess we lost him.
If you hear us, can you please try to reconnect?
I think we might have lost Bill.
Let me see. Bill, you might want to drop off and come back on.
Yeah, I think he just dropped off. Sorry guys for this issue. One thing with technology, it's not 100% reliable.
Oh, I think Matt Kubik
Yeah.
is the co-author. So Matt, you want to jump on?
Bill is back.
Bill back?
Yeah, I can see him, but he has to mute. You have to mute yourself.
there we go.
Okay.
All right, sorry.
Okay, yeah.
It bombed out. I don't know why, but let's keep talking.
That's okay. Anyway, so thank you very much. Very
Absolutely.
interesting.
Okay, I think the next question we had was from April. If you want to unmute and.
Yeah, hi everyone. Thanks for doing this to begin with. Bill, very nice presentation. Really enjoyed it. So I have a question. I think one is a question, and then that leads me into an alternative explanation for your findings. So if it is a budget constraint, if it's a crowding out, I was surprised that the only thing that seemed to crowd things out was this SST stuff. I would have, in fact, expected other, types of, non-accounting, investigations, right, to crowd out other things.
Yeah.
So I was just wondering, maybe there's something special about these firms that are, that are being investigated for, for the SST. And I'm just wondering that if I'm a company and I'm engaging with these parties, maybe I'm being more cautious. Maybe I'm being more cautious in other areas, including my accounting. And therefore, the reason I'm not being called out for having, bad accounting is because I don't have bad accounting. So I was just wondering if you consider that as
so how we thought about that was two ways. So again, to your point about, maybe there's something special about these firms. All we can do is like match on observables, right? And kind of do the matching thing and see if that changes a bit, but that doesn't really, get at the heart of your question. So the closest thing we have to that is going to be the evidence on the error subsample. So I think your concern is if you're in column 3 here, and you're just saying, hey, look, maybe you're just clean. You're very good with accounting. The reason you get a negative relationship here is because you're clean, and they're just asking about SST, but because they don't have anything to ask you on accounting. So the best we can do is kick over to column 5, which is the known error subsample, and say, look, all of these firms have accounting problems. Fact. Did the SEC catch it? So that's the closest we can get.
Well, my question is actually reverse. I mean, my question is that if you have an SST problem, you may not want to raise any other red flags. So therefore, you're being very, very careful in your accounting. So in other words, your motivation is going to be different. Because again, it seems to me if there's a crowding out, a budget constraint, it seems other things should be knocking out, the accounting, not just this one particular investigation.
Yeah, I guess to deal with that, you'd have to have some sort of proxy for, I'm going to be extra careful with accounting because I have SST. So basically, I'm going to get around, I'm going to be so sophisticated that I know the SEC is going to come after me, so I'm going to super hide it if they start asking about SST. That's kind of the spirit of what you're saying, right?
Well, not super hided. You're just not being a bad person.
Well, in the known error subsample, you are bad, right? To some degree. I mean, I'm conditioning on the fact that you've got an accounting problem. It's a fact. I know that ex post. So I'm trying to condition into the sample that's, hey, look, we know you've got a problem. There still could be variation there if you have some sort of, super accounting strategy to get around the auditor or something. But I think the reason that we're seeing the effects we do has to do with just kind of the questions that are asked. So with SST, they're asking about time zones on a website. Some people argue that that's not really going after material information. And if you got a budget constraint, there's only so many things you can do, I guess. And, why does this come at the expense of accounting? I think you're asking, why isn't something else crowded out? It may have to do with the expertise of accounting versus lawyers. And that's as far as we're able to kind of push the story to see if the crowding out appears to be exacerbated by lawyers, because we know the labor mix is shifting. But that's the reason we went to the labor mix, was to try to get more color on this, because we've kind of pushed the data about as hard as you can in terms of, kind of comments and that sort of thing. But that's as good as we could get related to your point.
I actually found the labor mix, accounting mix very interesting.
Well, that was cool. I mean, we tried to get more information actually from the SEC. That was the only thing we could get ultimately back into FOIA, was a listing of names. We tried to ask for lots of other stuff related to effort and phone calls, and they wouldn't give us any of that, as you might expect. But I think seeing the labor mix itself is a nice piece of data to better understand, what resources are available to deploy. Because if it's a budget constraint story, you got to know what's the budget that you're working with. And that data has never been, I guess, observed by anyone until we were able to get it through a FOIA.
Thank you.
All right. I think next we have Daniele.
Hi, Bill. Very good paper. I think you sort of asked this question too early. You probably sort of answered this question with your table 4, but I was trying to understand if you would expect the same type of effect if you were studying the effect of complex firms on the SEC probability to find accounting mistakes. So I guess my question is to try to see, or to try to understand whether you are studying something that is very specific to terrorism, or if this can be generalized to any type of other activity that can distract the SEC from their major goal.
Right. Well, I mean, part of the reason, you might say, well, why did we pick terrorism in the first place? That's the one that kind of had the biggest press and the biggest pushback from people. Like, we didn't have any other one where there's a bunch of trade organizations saying, SEC, why are you focusing on non-GAAP? Or SEC, why are you focusing on, some other topic? So the reason we picked SST wasn't, just kind of go down the list of possible comments. I guess we started there because we had tension we could point to. And then it becomes on us to say, is this generalizable to something bigger? The only thing we could think of was because the Office of Global Security Risk classifies this explicitly as a risk factor. That's the reason we did table 5 here, where you've got other risk factors, to see if this is just a general risk factor phenomenon. Now, what it doesn't do, related to your point, and arguably April's from before, is, why doesn't this crowd out? Why is it that, non-SST risk factors have no effect on errors and actually are complementary to other comments? I don't know. We kind of picked this stuff to try to rule out, in some sense, that we're just picking up a general risk factor effect, but we haven't gone down the path of, what's the full complete trade-off set between every type of comment you could ask. And, if we had good reason to do it, we're all for kind of better understanding this. We don't definitely know the reason why other things don't crowd out. Why isn't the budget constraint binding? The people that complained about this would say, SEC, you don't have the expertise to deal with terrorism. You have the expertise to deal with, other risk factors like commodities or CEO turnover or any of that stuff, but you don't have the expert. I didn't see complaints about that, I guess. And so that's what motivated, I guess, the focus on SST the way we did it.
So if you were studying the same question, but looking at non-GAAP rather than SST, would you expect the same effect, or would you expect no effect because non-GAAP is still in the accounting area, and so you would expect them to catch the mistake, the SST to catch the mistake?
So I think so, and I think that's part of the reason why we did the crowd out test was what are the things that are related to accounting numbers? You know, what are tied to it? Because there you get not a lot of slippage between someone that's a pure expert in accounting. It would make sense that they know something about non-GAAP, something about the MD&A, not the whole MD&A necessarily, but you know, the discussion of changes in ratios and stuff like that. So I guess that's why we picked them. But you know, are there other comments you could look at that maybe, you know, fall more in a wheelhouse of a lawyer? We could possibly look at those. Then you'd want to know, are the lawyers excessively focusing on them? Because that's kind of the motivation for this whole thing. Is there's a big debate about whether the SEC should do SST per se. And I don't know a lot of other arguments on other dimensions.
Thank you very much.
Right, Atif, if you still wanted to ask a question.
Yeah, hi, Bill. Thank you. Again, very interesting presentation. My question is related to Gennaro's question, which was the first one, I think partially answered. It seems like there is a data constraint here in trying to see if there was an increase in comment letters around some, and you mentioned there wasn't a shock that you observed, but I was really curious if 9/11 was one of the contributing factors, and if that was a way to see an increase in the proportion of comment letters that increased, you know, your focus on SST. So it was, I think it's probably not doable given the data wasn't available publicly, but maybe, I know comment letters existed before then, so I mean, maybe there's something to do here.
Yeah, so the data we've got is just kind of the publicly available comment letters, right? And you can see this is the closest we get here where we're measuring daily global terrorism. You know, like I said at the beginning, this isn't a diff and diff paper. We don't have the shock where you just run a t-test and everything's kind of done as long as you got parallel trends. So we've got to kind of kill this with 1,000 paper cuts, if you will. And so that's part of the reason for you know, the sequence of tests and the patterns, because now if you have a kind of a story, you know, the reason you want a diff and diff is you just don't have to worry about other stuff then. But since we don't have it, we have to worry about other things. So if we can set up a set of results that actually suggest a budget constraint issue on SST, then when someone forwards a competing hypothesis, then we can take it to the data and see, does it thread all the results we have? And one of the troubles you have with a paper like this is, you know, at what point do you stop? So, you know, a prior version of this had a bunch of other stuff in it too, because we're trying every possible way. And then, you know, then you get comments that are like, well, the paper's too unfocused. So we're trying to hit the sweet spot on what's the evidence that's convincing without getting distracting, which is you know how it is. It's a tricky blend, but you know, this is the first version where you've seen like kind of a complete overhaul of the paper where it's a bit more narrowly focused in a linear progression. Yeah. So the feedback you have here is just absolutely fantastic. So I appreciate it.
Okay, great, thanks.
Next we have Shen.
Hi, I'm Shen, and thank you for your presentation. I think you have explored the whether the SEC budget constraints have crowded out other types of SEC comments to a specific firm. And my question is, will there be some overall effects, such as will the number of firms receiving the comments reduced, or will some types of registrants will not receive the SEC comments? That means will some types of firms be less likely to be caught after this non-GAAP regulation?
Well, so I think there's two kind of themes running through your comment there. The first one is there spillovers to other firms? So when one firm in the industry gets a SST, to do the rest?
Yeah.
Is that fair? Is that kind of what you were suggesting?
Yeah, exactly.
So most of the time you see the spillover test, that's how you get the instrument, right? You take some peer firm in the industry and you use them as the instrument. So we kind of thought about that in terms of actually trying to do this test right here, the two-stage. But we were like, well, what's the most primitive thing here that would be exogenous to the system. And we said, well, if we can get data on daily terrorism, let's do that. So, you know, you could argue, hey, try a different instrument. And, you know, I get it. I mean, we can do that. In terms of, you know, what are the characteristics that make a firm get a SST? We're going to match on those explicitly, you know, kind of in our matching tests. But, you know, we don't have a theoretical model about how, you know, effort gets allocated in theory to design the match on that. I mean, we're just kind of using what's in the literature and saying, hey, look, if our match isn't good, it has to be the case that the unobservable is driving the coefficient difference. And it's so stable, like no matter what we did, like you just can't make this negative coefficient go away. Like it's just there, and it's about the same magnitude. It's very robust. And so, you know, is there the potential something is hidden in the background? Maybe. Is there a potential to think about lag lead effects? So if one firm gets it, what happens to future firms? You could potentially do that dynamic. One of the problems we ran into in our last round was we were kind of looking at dynamics about, you know, if a firm gets SST, is it more likely that the OFAC is likely to hit them with a sanction explicitly? We don't have that in the paper anymore, but, you know, that's something that we could definitely, you know, look at. And related to the earlier point, I didn't show you all this, but if you look at sanctions, you can actually look at sanctions in other parts of the government. And, you know, on the left here, this is the OFAC. They're the ones that actually penalize firms for dealing with state sponsors of terror. They actually fine you, right? So that's kind of the risk exposure you have. So if you take over on the right is the subset here of these that got that actually got busted, the dollar amounts that pertain to SEC registrants. And when we look there, we don't see much overlap between SST comment and actually getting a sanction. And so, you know, when you're asking, you know, what kind of drives sanctions, are there other exogenous things? This is another thing we thought about was if you see sanctions being handed down in certain countries at certain times, you know, maybe that's what's driving the interest in SST. But when you see not much here, it kind of makes you wonder, you know, is there a shock here, or is this really just kind of political pressure to look like you're kind of being a watchdog in SST, but there's not really any relationship with other kind of risk? I mean, this is the risk, right? The risk is you're going to have to pay some sanction eventually, and we just don't see much relationship with it.
Okay. Okay, thank you.
Sure, thank you.
Doug, Hannah, I think you had a question.
Hello, Bill.
Hey, Doug, how are you?
I'm doing well, thanks. I think April introduced this topic, but if this is going to be motivated by an attention or budget limitation argument, I am having trouble figuring out why SST is different from other accounting issues. Now, you've tried to test this, and I'm puzzled that you don't find the same result with the accounting issues, but should you do something more directly comparable to your original result, like taking a particularly complex accounting issue, and when that is present, seeing whether or not the SEC is able to detect the original restatement issue?
Yeah, we could do that. I guess I mean, there's an infinite combination of stuff we could do, right? And the trick becomes, for a budget constraint to be binding, kind of in our view, you need to have some sort of existing budget constraint that isn't appropriate for the outcome. So, you know, here, I mean, people were explicitly complaining that the SEC, you don't have people that know how to even think about a risk factor in global terrorism. You don't have the people to do that. And that's the reason why the budget constraint would be binding. So I guess we're not thinking of it as a, you know, everyone has accounting expertise, but the SEC Division of Corporation Finance is redlining on every issue, and they're at the max, and any issue you hit them with is going to turn into something bad because there's synergies, right? There's synergies between non-GAAP, and obviously we're seeing that in the data to some degree. You know, this is one where there was a claim that you don't have the expertise. And so that's, in our sense, what we're talking about with a budget constraint. I think what you're suggesting is there's other ways to think about the budget constraint. And a lot of it depends on where's the slack and what's the expertise mix that would, for example, lend itself. Suppose we could decompose the accountants into people that worked in revenue recognition and not. And then would you expect to see, if you got a bunch of revenue recognition standard changes, that the SEC would miss more on RevRec, which is, that's a new issue, right? So, revenue recognition rules just changed. So I think the analogy to our test would be code accountants, if you could, on their background, find whether you have a deficit in revenue recognition people. In that case, I would expect to see what we see for SST, but that requires a very narrow and detailed application or discussion of the nature of the budget constraint problem. And the budget constraint problem we're running with here is kind of what we've seen in the popular press, but that's not to say there's not other ways to think about the budget constraint. I think what you're saying is plausible, and if we could measure things appropriately in terms of decoupling like accountant expertise into domain specific issues.
Well, what you're suggesting, you'll never be able to do, because you're not going to get that level of expertise data with a high degree of probability. But
Yeah, right.
there are things you can do. Were they less able to detect other accounting problems when the revenue recognition or lease accounting rules were being initially implemented? I mean, the idea that SST is complicated but accounting isn't, and we can deal with infinite amounts of accounting complexity, seems unlikely to me. So you simply might want to rethink what your budget constraint argument suggests as a proper sort of robustness test to see whether or not this effect isn't demonstrated elsewhere.
Yeah.
Thanks.
Yeah. Thank you. Yep.
Next we have Brian White.
Hi, Bill. Thanks for doing this interesting paper. Matt mentioned it when he interviewed here, and so I'm glad we got a chance to see it. So following up on the previous comment, and I think several comments starting with April, I think, there's been this question of whether there's something special about SST, and so if it's getting attention, then other areas are necessarily getting less attention. But I was thinking about it, is there something special? I was trying to kind of scan the psychology literature to see if there might be, and I think there is. I don't know how helpful it is in that I'm not sure you can do anything about it. But I think there is some research in psychology that says, something that's vivid and emotionally interesting, like SST, would make it particularly difficult to shift attention away from that into kind of more mundane or neutral risk factors and issues like accounting issues. And though it's different than you're saying.
How dare you say that to accountants? I'm just kidding.
And I mean, it's different in that these are individual, decision making and judgment studies, where you're, I think, talking more about kind of allocating resources to a team of people. But even on an individual basis, I think there is some evidence that if we're directed to focus our attention to something that's particularly vivid and interesting, we may find it hard to shift away from that.
Well, so I guess maybe a way to think about, so yeah, I appreciate that. So there's ways to try to characterize the nature or the cost of shifting, right? Which is kind of what you have in mind. There's frictions to shift between certain pairs of topics, right? I guess one way to think about Doug's comment and your comment, and maybe even back to April's at the beginning, was you got the Division of Corporation Finance set up. It's designed to look at accounting issues and related issues in a 10K filing, for example. And for many, many, many years, so what we're looking at here actually is a legacy issue. Like if you go back to the 70s, people have kind of pushed the SEC to look at all sorts of things that were beyond the scope of what their core, people believe their core mission to be, right? And so you can think about budget constraint within our old standard framework where, you're looking at standard accounting issues over and over and over. Is SST kind of beyond the scope of normal? And I think people's arguments are it is part of the reason, and this isn't, I guess, spelled out too well in the paper in this draft, but a lot of the argument about SST is there's no materiality threshold to it. So with other things, there kind of is. And even though the SEC says, we care about material information, if you sold one Barbie doll in Iran, then that's material. And so you can imagine if you're going to run after that, that's a different type of pursuit of using resources than it is to think about whether a non-GAAP reconciliation, didn't decouple two line items enough to get granularity on it, right? So, because with accounting numbers and that sort of thing, you have materiality thresholds that are in some sense established. And one of the novelties and one of the big arguments in the law literature is, should we even go after SST? And the arguments on the benefit side, because they're arguing, well, people need to know if there's one Barbie doll sold, that's important for an investor. And other people say, you know what? It's not. Like, it's just materially not from a dollar standpoint. And so the argument on that is a bit different than, most of the other standard things you see in comment letters, like, MD&A, non-GAAP, accounting issues. So I think that's one of the differences. We've kind of toned that down in this version, but maybe that would help as well to kind of suggest that SST is its own unique issue. And, maybe we need to do better with that.
Yeah, thanks.
Right there. Ramon?
Yes, Bill, thank you for your presentation. Great stuff. So one thing that I really like in your paper that you focus on the accounting expertise of the SEC examiners. And I was wondering if you guys consider the accounting expertise in the firm itself. So maybe these firms that operate in these countries, right? They may focus more on lawyers, their staff, or management, or board, and less accountants, right? And maybe that's why you have more of these accounting issues. In fact, Miguel, Andy, and I, we have a paper where we show that for firms with complex accounting expertise, internal accounting expertise matters. These firms get less common letters and also less likely to have internal control weaknesses.
Yep. So I think maybe what you're suggesting is, if we saw these same temporal patterns in terms of the shift of accountants to lawyers, maybe the SEC here is matching what's going on in the latent economy, where firms are, do you use board composition or executive team composition?
Board.
So,
committee,
if the mix on the board is tilting away from accountants, now I know there was rules to, some would argue that it's always been tilted away from accountants and you got to make a rule to get an accountant involved in the first place. But, if we saw a temporal shift like this, maybe I think your point is maybe it's matching the nature of the firms better. And if that's true, if you can find mismatches where there's kind of an off diagonal, where you've got, a bunch of lawyers at the SEC, but you got a firm with a bunch of accountants or vice versa. Is that what you're thinking about?
Yes, exactly. I think be like interesting another covariate you can look at, right? So does this matter?
Right. Well, here's another thing I would another thing that might help with some of the earlier comments. This isn't in the paper anymore, just to avoid distraction. But we have looked at. You could imagine. Can you learn anything from the stock market reaction around the restatement? And so the evidence there is consistent with everything else we saw. If you're SST and you have a restatement, the market reaction's bigger, which kind of suggests, yeah, you missed more of the problem when SST was there. That's a sort of test where you could cut on all sorts of these variables. You could look at non-GAAP, you could look at anything else, I guess, and see, what was missed, and does it have a similar, use the market return at the restatement to kind of speak to the, I guess, the pecking order in this, without having to directly measure, expertise of the accountant on revenue recognition versus not. So there might be other ways we can backdoor this to try to at least provide some color that SEC, SST issue is unique and important in a pecking order sense, but we haven't, that's not in this version, but I know we can show that in the data.
Thank you.
Sarah?
Hey, Bill. This question, I guess, is a little bit similar to Brian's, but I was wondering, do you have a sense for whether the common letters that have to do with SST issues, what led to them being initiated in the first place? Like, was the SST the most salient feature? And then is it possible that the SEC might take the perspective, well, while we're already looking at this SST thing, let's do like a cursory examination of the financials. And in that sense, it wouldn't really be coming at the expense of detecting financial issues, because the letter wouldn't have been initiated in the first place.
Yeah, so the whole selection issue and the magnitude. So those are two kind of things that we kind of punt on because there's nothing we can really empirically do about it. So, you know, when you get a comment letter, the SST coding of that, and by the way, like, so the coding of SST is just either you had one or you didn't. If you had two, you know, separate ones, two separate issues, three separate issues, it's just coded as you had one or not in the data set. What we did to look at that, we went and coded them all ourselves to look at variation within that. So let me see, here it is. It's in table 2, panel B. So we went and read every one of the SSTs that were coded, and we find on average that they're talking about two things, you know, in terms of the sources, but, you know, you could potentially do more with this, but this is variation within the SSTs, not really variation across, you know, what made you get an SST in the first place. All we can do on that is say, look, we can run a determinant model SST, get a bunch of stuff to load, take the fitted value, match out on that.
Right.
But we're not testing like hypotheses on SST per se. And so really that's kind of the limitation of the paper in the sense that it's hard to do better empirically than what we're doing. And, you know, we tried to max out on variation where we could. Some of it, like in this case, is a bit descriptive, and we don't use this in the data to cut and say, did you have a lot of, take SST and cut it into a lot of SST versus a little SST. We haven't done any of that yet. We did more substitution effects, but it's possible there's some latent variation that's exploitable by us that we haven't exploited.
Right. Cool. Thanks.
Probably have time for one or two more questions. So, Gennaro, did you want to?
Hi. I don't know. Do we want to give an opportunity to somebody else who hasn't taken a shot yet, or are we going to go all the way?
Yeah, we can. If you don't mind, I can call on David, actually.
Okay. Well, so my question, if you can show again the time series of the panel, those who were caught and were penalized and those who received letters. No, the one that you showed earlier.
With the graph, the terrorism graph?
No, you showed us the time series of the firms that were penalized for state-sponsored terrorism.
Oh, the sanctions. Yeah. Let me go to the sanctions.
There was a large discrepancy between the number of firms that you know, received sanctions and firms that received comment letters.
Right.
Right.
Yep.
I was wondering whether you had compared the disclosure of firms that received comment letters to those that didn't receive comment letters, but you know, we know that they were both penalized. They were both sanctioned.
Yeah, we haven't done that. We could do that. I don't know what the overlap's going to be in terms of data points. How many data points can we get doing that? But we could do that. We haven't done it though.
Okay. I think we can learn something, right? The question of why some firms have received the comment letters and others haven't, even though they were both sanctioned, they were both displaying this risk factor, right? I think we lost him again.
No, did we? Yeah, we might have. Bill, did we lose you again? I think so.
Must be me.
Well, it is 1 o'clock anyway, so we might leave it there if I think we've lost him. Yep, that's what it looks like. So I guess I'll end it there, and I'm sure Bill would thank you, and we obviously thank Bill, and thank you guys for joining. Hope to see everybody next week again. And thanks a bunch. I know there was a couple of questions we couldn't get to, but I'm sure Bill and his co-authors wouldn't mind if you just reached out privately. All right. Thank you, everybody.